Hello there, Ado from Resource Investment Media. Today I'm going to touch on a topic based on a question that I got from a viewer. And that question is actually regarded to inflation and the commodity sector. So I wanted to touch a little bit today on inflation as a general topic and a little bit on how it affects commodities in specific. So I guess the first question that you really kind of have to address is, what is inflation? And that may seem like a very simplistic question, but actually it's not. And even among higher degree academia, you will see a lot of difference in opinion in regards to what is inflation. Now, there is a base case for inflation simply being the CPI, the Consumer Price Index, meaning that a basket of goods that is selected and managed by a government agency and measures, I guess, the price increase from time period towards different time period. And this is, I would say, become the accepted calculation for inflation when it comes to mainstream media, when it comes to most of academia, and when it comes to, I guess, government agencies. So that's the inflation number that you are most likely to see in the news, regardless of where you live, really, if you live in Europe or America or wherever, really. So is that number correct? Becomes the immediate initial question. And if it isn't correct, or if there is a difference of opinion in regards to its correctness or not, what is it based on? I would say this, that CPI focuses on the increase in prices of selected goods, while money supply itself, M2, focuses on how much money is in existence. And in order to see which of the two you would feel were more valid, I'm going to use a very simplistic example. We're going to pretend now that there's an economy here, and just you and me in the economy. It just consists of you and me. And now there's 100 units in this economy, and I'm the central bank in the scenario. And now I print 100 more, and I just keep them in my bank account, or just keep them in my, I guess, my own facility. And then nothing happens and a year passes. If I asked you what was the inflation rate within this very, very small economy of just you and me, I think most of you would answer, well, there was 100 and you created 100, so you doubled it. Well, that would be M2, money supply inflation. But Consumer Price Index would say, no, we have to check how much did the goods increase in this economy in price between you two, not how much money was created. So in my humble estimation, the M2 actually measures inflation in the word it was first intended and used, to inflate something, to increase. And hence I think that M2 represents a lot better measurement and calculation of inflation than what CPI does. Now, Consumer Price Index, CPI, has a lot of other areas you can focus too on that are very, let's call it, interesting. There's something called hedonic adjustments, which means essentially that, well, first of all, you buy an iPhone and it costs twice as much as the previous one did. Did it get twice as expensive? No, because it got 3 times better according to the people who make the index. So we actually have deflation on that good. But then you come into the natural question, what is better? How do you measure that? Isn't that inherently subjective? Shouldn't you just measure the best technology available at that time against the best technology available 2-3 years ago? And in that essence, CPI understates inflation. And then you also have the adjustment of goods, which is very interesting, or as I said, the replacement factor, which essentially, if milk is too expensive, then we'll put it as a lower weight in the basket and we'll put more Coca-Cola, because you're going to buy more Coca-Cola when milk is more expensive. And I've heard a funny example of that. Yeah, by that logic, when meat gets too expensive, we should just replace it with dog food, because then you'll eat dog food instead. So there is to put it lightly, there is some controversy in the measurement of the Consumer Price Index. And now, why does this Consumer Price Index, I guess, measurement, why is it filled with so many flaws? Or at least in my subjective opinion, filled with so many flaws. I guess the simplest answer is that the person or the entity that is responsible mainly for inflation is the one that prints money. And the one that prints money is a arm of the state. And the state itself has an incentive to understate inflation because it is the root cause of it. So when you realize that it would kind of be like a kid who hasn't had the best time in school gets to set his own report card. He's going to be very incentivized to give himself better grades than what he thinks he deserves, simply because it will perhaps give him a better future or not put him in trouble, make sure that he has an easier time to be elected as, I don't know, school president or class president or whatever. You see the analogies towards our society today. So M2, in my humble opinion, is what most people should refer to when looking at inflation. And if you yourself start calculating your own purchasing power loss rate by M2, it actually starts becoming staggering, and you realize that cash really bleeds out a lot of purchasing power, and it actually doesn't even require as much time as some people think, because the compounded rate of losing purchasing power sometimes can mean that just in a period of 4 to 5 years you've actually lost a lot of purchasing power just by sitting in cash. So I guess another effect of inflation that the investor and the speculator, not just within the commodity space but within the commodity space, needs to understand is the Cantillon effect. And now money is printed. When M2 is increased, money is created. Money can really only be created by central banks or by commercial banks. Most people don't know that today, by the way, that in most countries, at least in the Western world, over, I think, 90% of the M2 money supply actually comes from commercial banks in form of bank credit, and not from the central bank that issues it. So the central bank can control money issuances within the private banks through, I guess, incentive mechanisms such as reverse rates and interest rates. So they do have certain mechanisms to kind of control that above 90%. But the idea that they're just printing out physical bills and handing them out to the economy, it's not really how it works today, at least not in most of the, I should say, Western world, US, EU. The Cantillon effect, to go back to that though, is when this money gets created, it has a few pathways historically it can go. From a central bank's balance sheet or from bank credit within the bank, the path towards the stock market is very, very short, and towards the bond market. Meaning historically it has a very, very easy effect to find its way into financial markets. Now, that comes with certain benefits and certain, I should say, negative aspects, depending on who you are. If you're a person who already owns financial assets, well, then that will most likely increase your wealth. While if you're a person who lives paycheck to paycheck, you actually get deminimized quite substantially over time by this Cantillon effect. So as an investor, I guess understanding that the Cantillon effect to a certain degree benefits the very markets that you are in is important, because then you can assess it more from, okay, M2 is affecting, and I mean, Cantillon effect, I guess you can count in, I shouldn't say you can count it in together with M2, but there's a base effect from both that is combined, and understanding that certain reasons why the stock market goes up is not just because that everyone who invests in it is such a brilliant investor. It's actually a monetary phenomena. And understanding that will mean that you're less likely to confuse brains with bull market, and you'll be more humble in estimate to whether or not you're actually growing your purchasing power, not whether or not you're actually just getting gains. And now, final point to touch on a little bit, I should say final, but at least a final point before going commodity specific, is this system has some inherently negative aspects of it, the inflationary debt monetization system. And that is that many of you have a day-to-day job, and you're going to start every day by waking up, fixing yourself, getting ready to work, and then going and doing a hard day of labor, and you're going to get paid for it. And certain individuals who work within central banks actually just sit in front of a screen, press 09000 and enter, and they create money. That's, you can say, oh, there's a process of it, more people have to prove it, but in its most simplistic form, they're actually just putting numbers and zeros into, I mean, I should say maybe 9, 7, or 8, and then a bunch of zeros after it, pressing enter and creating money. That in itself can be described as a very, very horrific system. And I know that's a strong word to use, because if some people have to work very, very hard for the money, while others have privilege to just print it out of thin air. There's no cost associated. The marginal production cost of $1 or $1 billion is the same. It's the computer that you need to buy and give Jerome Powell. Once he has it, really there is no marginal cost anymore. So then you kind of realize that, well, okay, but for you there is your time, your effort, your labor. And for a producer of a commodity, there is too. There's a capital intensive business, there's risk, there's a lot of associated with it. But a privileged few actually just get to press on an enter button and create money. Now, the argument for the system is that, well, then they'll distribute it to society and it will be a better redistribution effect. I don't know whether or not, I don't really have an opinion as to regards to that, if that's viable or not. It's just an interesting conclusion to see that sometimes the very defenders of the system will say, well, it's better for a welfare state. But then again, you have a lot of workers who have to work very, very hard every day, while a political class actually just creates money out of nothing. I'm not sure how that benefits. It feels counterproductive to the very essence of the goal that you will be trying to achieve. So there is, somewhat people would say there is a degree of evilness or harm towards inflation and the way money is created. I would be one who probably thinks that it would be hard to discard an opinion of that sort completely, because there is a lot of truth to it, just from a very first principles, basic logic thinking, that if somebody can just create the monetary unit and there's no work behind it, it puts everyone else in a system where they're almost working for free for these people, because what they're creating is effortless. What you're doing requires a lot of effort. So, and I guess to finally touch on commodities and inflation, high inflation environments can sometimes become very, very tricky when it comes to commodity production. Because let's say now that I have a uranium mine, or even for that matter, a silver mine. And now, okay, I have a lot of capital that I need to put into this to get into production. It's a capital intensive business. I need to plan, I need to make budgeting. I need to see whether or not this can become profitable. Now, in order for me to perhaps want to start a big mine of a high degree and with high capex costs, I would want long-term contracts. But okay, now I see that inflation is quite rapid. Would I be comfortable signing a contract that is 5 years long to produce uranium for a fixed price? I probably wouldn't. I'd be very nervous. I'd want some reflection towards the spot market, or I'd want inflation adjustment for some of my costs. But then again, the buyer on the other side then also has a quite staggering effect, where he has a very hard time to calculate his expenses from this purchase, because there's such a variability factor due to higher inflation and due to the indexing of the contract. So contracting in itself, long-term contracts, become tricky, and that in its essence, can disincentivize new supply to a certain degree. So you do have an effect that inflation, while some would just say, well, rampant inflation is going to mean increased prices in commodities and hence better profitability. Well, first of all, miners are going to feel the inflation both on their, not just on their sell side, but actually on their cost side too. All their expenses are going to increase due to inflation too. So it's not a given that it's a dream scenario for commodities with inflation. I would say inflation does tend to spread a fear within the markets, and commodities do tend to perform relatively well in fear-based environments, simply because you go back then to the basics and you look at, what do I need for my survival? Well, I need energy, I need food, I need certain materials, I need, I guess, you become less inclined to pay for a lot of just cloud services and things online, and you start looking towards what is more my basic needs according to the Maslow pyramid, and how can I fulfill them. And in that environment, commodities do tend to have a higher, I should say, higher category rate of preferences when it comes among individuals and how they choose and select. So to give you a conclusion on it, I think commodities, sometimes inflation within commodities is presented like a unique phenomena that will drive their price in very vast and different ways compared to other services or goods in society. I would say that's partially true, but not completely. because the inflation does hit long-term contracting. It does make it hard for price stability, which always kind of can become a supply deterrent, which in itself long-term can drive price even higher. But then again, also, I think we saw yesterday that there was a profits windfall tax in Great Britain on energy sector. So you also always have the risk that if you have an inflationary environment that is disincentivized long-term contracting and you're not getting new supply in, there's a risk that some of this price increase will also just be taken by the political class. So there is a unique element when it comes to inflation and how it affects commodities, but sometimes just hoping for your commodity or your stocks to increase due to inflation, I would say it can be an oversimplification, and sometimes over focusing on the macro is a little bit too short-sighted too, because the macro is what you get. The micro is what you do with it. So you still need to find excellent companies within that sector that can grow regardless of if an inflationary or disinflationary environment is going to be present. So people underestimate the micro sometimes and they overfocus on the macro. So that is my conclusion on inflation and how it affects society in general and how it affects the commodity sector. So if you enjoyed this video, do not hesitate a single second to like, subscribe, and yeah, take care. Cheers.